Welcome one, welcome all to DeFi Crypto and Airdrops. I am Mike, aka Veteran Crypto, and with us for our usual Thursday show, we got Jeff, our TradFi expert, and Taylor, a state lawyer that deals with wills, trusts, and basically ways to protect your wealth. Once you earn it, you got to protect it from the government and everybody else that's trying to get their grubby hands on it. So, how you gentlemen doing today?
Great. Got my lunch right now.
your sour, your Sour Patch Kids breakfast or lunch of champions.
Exactly. And I wonder why I'm fat.
That makes one of us.
Because
Yeah,
you like delicious things.
I know. I love sweet things. I've learned that that is so true. All right. What do you want to jump into, Mike?
First off, anybody that's watching on X or on Rumble, if you want to join the conversation with Josh and those in the chat, if you want to jump on over to YouTube, it's DeFi Crypto and Airdrops. You can join the chat. Our brother channels, we got Discover Crypto, Blockchain Report on Saturdays and Mondays. Me and Jeff do deep dives into early projects. If you're looking for small caps, kind of early gems, potentially you can find them there. He does the airdrop portion of our show. And so he gets in on projects when they're in their infancy. So a lot of times before the token launch or token generation. So really good place to get some info. On Wednesdays, Jake Call over at DeFi Income. He is going to be on our Wednesday shows along with David, who used to be with Crypto Labs Research and is striked out on his own to start a DeFi Academy or a DeFi University. So that's going to be our regular Wednesday show. That's going to be hyper focused on DeFi and advanced strategies because those guys are freaking 20-pound heads when it comes to DeFi. So I actually enjoyed yesterday's show because I actually learned a bunch from them. But over here you have Taylor's website. If you are in the Dallas Fort Worth area, he's out in McKinney, but it's the Willingham Law Firm. Again, they do elder law, probate, estate planning, business tax consulting, all of those sorts of things. And then Jeff, have you updated your website yet?
No.
Damn you, Jeff. So Jeff has a website that he neglects.
You get me. My kids started school this week. I got to drop it down. Let's get the next week.
All right. Well, if you need
I have
help,
somebody that knows how to do it now. So
if you need help with that, let me know because I do websites. So let me know if you need help with that.
Fair enough.
But Jeff is a licensed financial advisor. So he's been in TradFi for a couple of decades now, and is Taylor's business partner there in McKinney, Texas. So if you're looking for somebody, they're your people. So with that, I appreciate Kyle Watts, Better Try Again, Alexandra G, Josh, everybody in the chat. Appreciate you showing up. If everybody on the way in, if you could like and share the stream. We do all this for free. We don't monetize any aspect of it. So anything you can do to help us, spread the word. We're trying to be a channel of integrity and make sure that the information that we put out is good, solid information and not because we're being paid, by a sponsor or something like that. So if you could help us out. So with that, let's go ahead and jump into things. Let's start with just kind of the macro. Crypto this morning had quite a bit of a pullback, but we've seen some really good gains in the past couple of days. Taylor, what are you seeing in the markets that potentially led to this pullback, and kind of where do you see it going, over the next days and weeks?
Well, I mean, it was a huge run for a few days there, and it just bounced off the all-time highs. A lot of people are going to put in sell orders right at the all-time high. I mean, you had both Ethereum and Bitcoin run right into it. So I mean, that's not a bears or anything you should be freaking out about. In everything that we can kind of tell in the market right now, there really isn't any reason necessarily other than, I mean, of course, things are overvalued, I guess we can put up, or it doesn't make really much sense what's going on with a lot of stuff. But there's nothing to suggest that you should, run away right now and it's, the whole world's going to collapse. It's going to come. There was going to be a pullback. It's going to happen. And then there's going to be a consolidation. So right now, there's nothing that I can see or what anybody else that I trust that actually gives data information, not, clickbait or scaring people kind of situations. But like right now, the dollar is de-accelerating again, so it's starting to go back down and not go up. And so there's really nothing until there's some major crack that happens in the market. It's gonna, I believe, break the all-time highs.
All right. So I got the heat map up on the screen here. Jeff, what can you tell us about the traditional markets? Obviously we got, looks like Tesla's down about 2%, Amazon's up about 3%. Kind of across the board, it looks like there's definitely more red than green. What are you seeing in the traditional markets right now?
I mean, I should have. Unfortunately, it's a very, very busy day for me today, but I can't really comment on today's action too informed. I do think that what I think is easy to notice pretty much, right, is that what's green is what has been green for the last three years. And I'm going to try to find this because it's gone all over. I'm sure Taylor's seen it, but it's been all over Twitter. And I tried to bookmark it, but I don't know where it's located. So I'm going to try to find it here in my likes while we talk. I'll wait and look when I'm not talking right now. I'll find it for later in the show. But there's a graphic that states that if you back out the top 10 stocks of the S&P 500, which, just to be clear, right, the S&P 500 is not technically the largest 500 companies in the country, but it's basically the largest 500 companies in the country. There's a few other, like there's technically a board that lets you in and out, and there's a tiny little bit of criteria around that. But the poor man's definition is the 500 largest companies defined by their market cap, which is if you bought every single stock in Apple today, the market cap is the price of the stock times the number of shares. So if I have a company that's $10 a share and I have 10 shares, then my market capitalization is $100. NVIDIA's market capitalization is like 4.8 trillion or something insane, right? So theoretically, if you could buy all the shares at once without moving the market, it's what would it cost to buy the company outright today? And what's scary about that, or what not that itself is just a definition, but what's scary about where we are in the S&P 500 is that 40% of the entire value of those 500 companies, if you were to buy all 500 companies at once, you'd be spending 40% of your money just to buy the top 10 companies.
Okay.
Now that says one thing. When you say it this way, that means that 2% of the number of companies in the S&P 500 are worth 40% of the value. Right?
Yeah.
So that's super skewed. And we've only seen that in history in a couple of times, including 1999, 1998, right? So if you back that out, if you said, hey, you know what, I'm diversified. I'm going to have a diversified portfolio, and I'm going to buy Exxon, and I'm going to buy Walmart, and I'm going to buy Disney, and I'm going to buy Warner Brothers, and I'm going to buy UPS, and I'm going to buy, I don't know, whatever. Throw out your favorite company that's not in those top 10, and you invested in all of that in 2022, you've gone sideways for 3 years. So all the growth in the market mathematically can be traced to those 10 companies effectively. Now, some have gone up and some have got down, but if you average it out, the growth has come from those very, very top tech companies. So as long as that's working, markets are going to rise or we're going to be good. When that stops working, if that stops working, we may be in for a really rude awakening because, the layperson, or for that matter, almost everybody, layperson or not, looks at the percentages, right? They're like, oh, the market was up 20% last year or whatever. We must be doing well as a country. No, we have a very concentrated amount of wealth in some massive, massive companies that are doing incredibly well, and everybody else is kind of treading water. So that's something that I'm keeping an eye on for sure.
Something along the two things that people kind of want to be is Bitcoin and Ethereum are still very bullish, like in their projections going forward right now, especially with Ethereum. What is happening right now is Ethereum is now getting ETFs, and there are billions of dollars that are flowing into it. Now that you're going to have institutionalized money going into Ethereum, that is a huge, huge, wind in the sail of Ethereum to push it forward. So that is something to be very mindful about. Bitcoin is still strong in every signal that's out there. It's so on the crypto side, it's not something to be any fearful at all right now. Altcoins, of course, are going to be altcoins. It's you're gambling when you do a lot of them, because it's all based upon how people perceive it and whether they're going to be involved. And really, there's no institutionalized money projected for any of them right now. I don't know if you've heard of any, Michael, that any ETFs or anything like that are being created for any other altcoins.
There's some other ones going on. Solana has some irons in the fire. XRP has some irons in the fire. A lot of the blue chips, the kind of the top 10, top 20 are kind of vying for ETFs. And me personally, I have mixed feelings about the ETFs. I think a lot of people think that the ETFs are simply going to pump their bags, where it has the potential, but there's a lot of complexity, and I won't pretend to understand it all. Jeff, you probably could speak more intelligently on it. But what I've noticed about the Bitcoin ETFs is that it didn't have the effect that a lot of people said that it was going to have.
Which is what?
Well, they thought that it was just going to pump it out of control. That basically it was just going to be nothing but up. And
I think this provides liquidity, but not in a pump way, just in a move in and out kind of way.
It's stabilized it.
Yeah.
I think that's more what Taylor said. It's a more accurate. I can't think of the word, but basically, I think that the more liquidity, and I've been saying this for a while, and it's just kind of simple. The more liquidity or TVL that Bitcoin, Ethereum, and these crypto projects get, because the overall market cap, for the most part, has topped out at 3 trillion. We're starting to get to where we're pushing past that now. Currently we're at almost 4 trillion, but that's a drop in the bucket, when you look at the overall, financial markets. And so the more TVL and liquidity that we have in the crypto markets, I really think the more it's going to flatten out. I think a lot of this volatility that we've seen in the past with, kind of the more speculative market, where it was really nothing but retail driving it, and the traditional 4-year cycle that Bitcoin and the overall crypto markets follow. I think that moving forward, we're going to start to see an evolution as institutional and government money and that the large amounts of money start to flow in. I think it's going to flatten out quite a bit. We're not going to have the volatility, and potentially we're not going to have the profitability that we've traditionally seen. So I kind of feel like we're in uncharted waters, and that's why I think a lot of people are talking about super cycles and extended bull market and things like that, is because there's going to be as regulation gets drafted and signed into law all around the world, then you're going to get this constant flow of liquidity coming in
Well,
that will carry us longer.
Okay,
Taylor.
Michael, let's stop talking about your feelings. All right. No, just kidding.
Yeah, yeah. No. If it was my feelings, my feeling is
Well,
when I got 400 or 500K, I'm out. I don't care what.
yeah. So when Bitcoin's first ETF was started on January 11th, Bitcoin was at 42,000. By the next week, within 1 month or about 2 months later, it was at 68,000. It's never really gone back close to the 42. After that, it bounced around. And then within 6 months of there, it was, about 8 months from there, it was at 101,000. So to say that the ETFs aren't affecting, I think they absolutely do affect price on things like Bitcoin and Ethereum.
I mean, it's not. I think with Bitcoin, it's a bit different. Bitcoin being looked at as a store of wealth, like gold.
Yeah,
I think that's a bit different than say a Solana ETF.
yeah.
You know what
Of
I mean?
course.
So I kind of feel like it's apples and oranges comparing the two. Absolutely with Bitcoin. I mean, there's been a rush of people, now that institutions and money managers and things like that can legally, get into Bitcoin. I think that you're 100% correct on that. But like XRP, Solana, a lot of these other, crypto projects, I don't think they have the same use case, for lack of a better term, as Bitcoin.
Yeah, and then but on like for Ethereum, just so people are thinking about investing it right now. I mean, at the time that IBIT was started, um, Bitcoin was almost at its all-time high. Kind of like the same story here with Ethereum, and it really has stabilized Bitcoin. So I mean, it makes Ethereum an attractive investment right now. I mean, I'm not saying it always will be or is gonna be thing, but I don't believe with all these ETFs started, you're gonna have it go back like it did just what it spent. Was it 3 years that it spent basically the troughs? I don't know. I don't know what the time.
Bitcoin, are you talking about when it was?
Ethereum's all-time high before this was in what, 2021?
So Ethereum's all-time high before was November 12th of 2021.
Yeah. So
And that was about $4,300.
was that? I thought it was 48 was our all-time high before. Oh, that was way back in the day.
Oh, sorry. No, it's 46.6 according to this chart.
Okay. So, I mean, it's kind of in the same area where, Bitcoin was all time high before that was in like 68, I think, somewhere around there. And then the ETFs got involved, shot it through its all time high, and it's never gone below the previous all time high with Bitcoin. But that being said, it's, it is, when we were dealing in this market, crypto is so speculative that it's one of those things of it can work great or it can't. I don't want to encourage people to run and go put all their money in Ethereum right now and then it tanks on them. But because like Michael, you pointed out, there it's kind of crazy because there's better projects than Ethereum that are out there. It's kind of interesting to me that they've chosen Ethereum as the next ETFs instead of I think I like Base better, but
well, I think the reason that Ethereum is garnering the attention is because one, it's been around for as long as it has. It's number two by market cap. It's more established. Pretty much everybody's building on it. I mean, Base Network is built on it. There's a ton of layer twos. A lot of institutions are building out their DeFi and RWA projects on it. Love it or hate it. I mean, me personally, I hate it. Just because the fees, the gas, it's gotten better.
Yeah, but you make a lot of money off those gas fees.
Well, I don't make money on the gas fees, but we do make money on the swap fees.
Yeah.
So whenever somebody's swapping, we make money. But yeah, I wish I made money on those gas fees. Um,
But so to kind of put that in perspective, like, Ethereum does have that whole thing where everything's kind of built off of it. If it did, I was trying to get the market cap for Ethereum right now. What is it? It's at, is it 500 million
so
billion?
the market cap right now is 547 billion.
Okay, and so so if it got up to, and Bitcoin's about 2.5 trillion. So if
2.34.
Yeah, because there are some credible people saying that because of its utility, that it will have a larger market cap than Bitcoin. I don't know if that's true, but if that did, it could be a pretty big push.
I mean, yeah, it's. I mean, I think there's a lot of variables, that could, play into that, and not to say that it couldn't happen. I mean, it obviously would take, quite a bit of, upside for Ethereum, but we are moving from a speculative market into a utility market. So, as utility is realized on a lot of these projects, there's going to be a massive culling. So, I mean, there's what is it, freaking right now there's 19.5 million different cryptos that are out there.
Gosh,
95% or more of those, fast forward, like a year or a couple of years, are not going to exist. It's just there. It's an ocean of shit. There, it really is. I mean, it's a bunch of meme coins and it's a bunch of projects that are promising, the world, but nobody's building on them. There's no community, and if there is, it's just they're just hoping that it pumps, 100x so that they can cash out. There's only a handful of projects that are actually really building out ecosystems that institutions, Amazon, Microsoft, JP Morgan Chase, governments, people that have large amounts of money and that are going to be moving large amounts of liquidity through those applications. There's very few projects that are part of that ecosystem. And that's, I know, where I'm focusing, and the people in our community is focusing, is we are looking for those partnerships, those parallels between different chains, and kind of the connections that create that web of utility, where the liquidity can move cross chain, like with Chainlink being an oracle. It connects different blockchains, or different chains, so that that liquidity and information can move cross chain. These are the projects that you need to look for, because otherwise, I mean, it's just a matter of time. You need to make your money and get out of a lot of these projects and make sure that you're invested long term in things like Bitcoin, Ethereum, and other high utility projects.
So I do wonder. I mean, this not that I want to be arrogant and presume we all have an unlimited runway of time in life, right? But I really think it'd be super, super helpful from an intellectual standpoint to see what happens to Bitcoin if we really did go into a real significant jobs recession. Not a not a market corrects, but like, oh, I hold Bitcoin and I'm a millennial and I just lost my tech job and now I need to pay rent without income and so I need to start selling my bags, sort of thing, right? I really want to see how resilient it is, and because until recently, or maybe even recently, it's been a massive what's called a levered beta play, which means if the stock market's going up 1%, Bitcoin's going up 2%. And if the stock market's going down 1%, Bitcoin's going down 2%, right? Whatever the ratio is. And obviously that changes based on cycle and all sort of stuff. But that's been like the super 100,000 foot view is like if risk is on in the market, then it's really on in Bitcoin, and if risk is off in the market, then it's really off in Bitcoin. And you can see that in
Jeff,
2022.
fuck you. Stop speaking evil into the world. I have a lot of money in Bitcoin right now.
You shut your whore mouth, Jeff.
I'm trying to give Taylor some props. He just cut me off. Which is
Don't
if we
speak evil into the world.
then we do go through that at some point.
Yeah, I
If
get
you
what you're
don't see, like, what was the last high to low? When Bitcoin went down to like 15,000, what was the high before that? Like 65 or something?
Yeah,
Hold on, real
I
quick.
get what you're saying, man. I get what you're saying.
So that was my point. Is that's like an 80% crash, right? If the market goes down, and I think it was 2022, something like that, 23, but the market went down like 25%. So it went down like 3x what the market did. If the market goes down 20% in the future and Bitcoin just kind of goes down with it, I think we've completely redefined cycle highs and lows at that point.
All right. So this is
I don't want my buddy to lose any money.
This is
Exactly.
pretty much the cycle of Bitcoin. So in 2017, it looks like it got to about $20,000. It crashed down to roughly about 3,000, 4,000. Then the next bull cycle,
Okay, so an 80% decline.
yeah, and then the next bull cycle we got up to about 70K, and then it crashed, and then now we're up to the recent high is about 123K.
So how much did it crash to from 70K though? Went down to like 15, 12.
All right, about 70K. If I remember right, it got down to about 16, like roughly 16.
Okay, so another 80% correction.
Yeah, but
so
again, we got to keep in mind that was when it was just retail for the most part.
Well, yeah, and it was pre-ETFs.
That's right? What I'm saying.
Right. So what I'm saying though is if we saw an all asset or most, like if real estate went down, if stocks go down, right? If we saw a significant multi-asset bear market that lasted 6 months to a year, something that wasn't just there's been a tsunami, or some asshole flew a plane into a building, but like an actual correction. Because people don't realize, like, for example, 9/11 was obviously horrific. And the markets crashed short term, but they finished they actually went up from that point, right? A little bit. So it's not these acute events, it's these secular events we got to worry about. So my point is, if we see Bitcoin hit a low of like 80 or 90, that's massively different than what it's done in the past. Because if it goes down, it's at 120, 130. What are we at right now?
Right now we're at 118, and
okay, so at 118, an 80% crash means you can buy Bitcoin again at 20 grand.
Yeah, and honestly, I don't see that happening with the way that things are evolving. Everybody that I'm listening to, and everything that I'm looking at, I just put these two lines up. I would say between 70 and 90K is where I think if we pull back, that's probably where we're gonna end up.
Yeah, I think that's. I think that's. Now it's sad for me. It's like, come on, one more time.
Yeah, right.
I think we get it though, right? I mean, because the reality is, and Taylor's spoken this before. We have such a concentration of wealth in the overall markets. I mean, yeah, you've got the average Joe putting the money in his 401k, but that's quite frankly, a lot of people even forget to turn that spigot off, even when until they lose a job. But the wealthy don't have to sell their stocks to make ends meet pretty much ever. So I really want to see how much of a relationship there is. And I think that will go a long way towards setting expectations for the future. But I also think that people need to understand that if it doesn't have those 80% crashes, it's not going to have 300% rallies.
Yeah,
that is 100% correct. I think as this liquidity moves into it, and that's why a lot of people are talking about a super cycle, and because now that the kind of the floodgates legally that a lot of this institutional money can flow in, that it's going to be like this constant that keeps the price up. But at the same time, it's not going to be these violent upswings. It's just going to be that gradual build. Kind of as it flows in, because it's not going to all flow in at once. So I would tend to agree. A lot of that volatility is going to go away.
I mean,
And
the
that's
largest liquid asset class in the world is U.S. Treasuries. And you don't see you don't see swings like that in treasuries, right? Because you're diluting the ownership decisions of where they should panic or not, invest or not, across basically every institution in the world and all the investors therein, right? So the more an asset gets bigger, the less volatility you're going to see because it takes so much more to move the boat.
Yeah, but the other thing is that people have to when I get on TikTok now, it's all like it's the altcoin season. We're all going to get rich, but it's like people don't understand. It's like there are so many projects now that are out there that the money is being diversified,
It's diluted.
It's being diluted across. Yeah,
and the retailers don't have as much of the money that they had before, and these institutions aren't going to go buy your altcoin. So you're not going to see what was happening before.
Some of them they will, because like Chainlink is being used.
Yeah, you'll get it in a few of them, but I kind of consider those not as much of the altcoins anymore. There's established good projects that are out there that are kind of the core. What I mean by altcoins, I mean there's all these other little ones that are just out there that are trying to make it. And those ones are the riskier ones that you're out there. You're just not going to see, like the guys did back in the day. And they were like, they put, $10,000 in and then, 3 months later, they're a millionaire.
Yeah, right. Or I think there's one more caveat to that too. Or they will, but because it's such thinly traded liquidity, it doesn't matter because you can't get out at the price that made you a millionaire.
Yeah.
It's just rug pull.
That happens with a lot of meme coins. People get involved with a lot of those meme coins and, on paper, they have millions of dollars, but there isn't the liquidity to pull it out. And if they try, then, they due to slippage, they end up, not, getting what they actually, on paper, show. So, yeah, I mean, there's a lot to this. And I think people really need to ensure that they're educating themselves and understand how this market is evolving. I see it a lot with XRP, and a lot of people think that I bash on XRP, but it's where I see the most attention, and
that's the scary thing.
Well, and a serious lack of the fundamentals, knowledge about the fundamentals and how it's evolved and changed over just the past, short period of time. So that is most of the reason why, people are going to make money on it, but go on TikTok, go on X, go on any social media, and it's just endless, posts about, the reasoning why XRP is going to go to $100 or $1,000 or $10,000, and people just eat it up. And I honestly fear for people that they're putting their life savings sometimes into some of these projects, thinking that it's just going to guarantee that they're going to get wealthy, and they don't do their due diligence. They just basically do it off of social media posts, and it honestly freaks me out.
I heard, actually, I can't even tell you if I heard this from a real person in the real world or just from a movie about investing. But there's some but the concept's very, very well known, right? Which is like, just know, like, anytime you think something is a screaming buy, somebody else on the other side of the trade thinks it's a screaming sell, right? And one of the reasons why there's a lot of cautions against retail traders and retail, especially like options and things, is Wall Street is a net seller of options, and their option books almost always make money, like print money year after year after year. All these investment banks, right? They're selling options. They're playing the house, right? They're being the blackjack dealer versus the bettor. And the math is extraordinarily in their favor historically. So someone once told me, this is a quote, someone once told me, who is a hedge fund manager, the reason that they don't trade a certain kind of instrument, and it was options. And again, this is a really, really smart individual. Certainly lights out compared to me. And they're like, oh, I don't do it because, and he starts dropping names of people he knows in the industry that are likely on the other side of the trade.
Jeff, can you explain what dual momentum is and the kind of the idea behind that, like that philosophy?
Sure.
It really helped open my eyes to how like investing in losers or things that go down is often a bad idea.
Right. So what's interesting is there's all kinds of, I'm going to hang up on this person because we're doing important things, right? So there's this myth of like a completely rational market, right? That, oh, everything's priced at any given time, exactly what the market values it at. And that's true in a sense of an execution sense, in the sense that like from moment to moment, the market evaluates things and makes changes. But it doesn't mean that the market as a whole can be completely wrong on what something is actually worth. I mean, look at Enron, right? It went from the seventh largest company in the world to nothing because there was fraud, right? But the market wasn't right about its value because there was things that were being hidden from it. And so momentum is this idea that when you go back and you look, there's these guys named these Nobel Prize winner Eugene. I think it's Eugene Fama and David French, I believe. But anyway, they're sort of the grandfathers of the efficient market theory, the idea that nobody can really beat the market. There's too many players. You just get in, you write it. They have actually there's quotes from them, these Nobel Prize winners, for literally saying the market can't be beat, that have said that the premier anomaly in the stock market that is pervasive always and everywhere is momentum. And it's just the idea, it's inertia in physics applied to finance. It's things that go up tend to go up, things that go down tend to go down, because you get these virtuous and vicious feedback loops. And so dual momentum is this strategy developed by this guy named Gary Antonacci. You can just Google it, dual momentum. It's really interesting. He's got a fantastic, super cool website where he basically he has two super simple filters. Now he's got more complex versions you can subscribe to, but the super simple filters are what's doing better, stocks or bonds, over the last 12 months. Whatever it is, that's the asset class you're in for the next 30 days. That's what's called absolute momentum. And then relative momentum is what's doing better, USA or international stocks, if you're in stocks. And you pick that one. And if you did that, and I don't have any of the stats memorized anymore, but like over the last 20 years, you got like, you trounced the market, right? You got like half the drawdowns and you got like double the returns.
So you're talking like buying stuff like Tesla and Amazon and things like that then.
Well, he's doing it across indexes so you're kind of getting rid of that idiosyncratic risk, because as certainly people learn, now Elon's kind of turned it around a little bit in the last 4 months, but when he was playing politics, right, he would say stuff that had nothing to do with Tesla, but would piss off a large enough percentage of people that Tesla stock would get tattooed. That's an idiosyncratic risk. Right? That's an Elon risk or a Tesla risk, right? So the open markets, you kind of don't really have nearly as much of that to deal with. But it's this idea that trends exist, right? The trend is your friend. You've heard these things, right? So there are ways over the long haul, from a very big picture point of view, I'm not talking about time in the market, that if you implement these things systematically, at least from a historical perspective, you've gotten better than average returns for lower than average risk. And it's not insignificant. I'm talking it's 3-4 percentage points a year difference compounded, right? So if you're talking about the market averaging 8 to 10% a year for 20 years or 30 years, and you do, 11 to 14, like that's not just a little bit more money, right? That's 3, 4, 5, 10x more money. It's because of the compounding. And I think that's the kind of strategies people should be employing, right? You should be doing something, if for no other reason than it makes you feel like you're doing something, which will keep you from making really stupid mistakes at the bottom or at the top, for that matter.
No. I mean, anybody that's been in any kind of investing, if crypto, DeFi, TradFi, anything, if you're trading or investing off of emotions, it's never a good thing.
I did find, by the way, the chart I wanted to share.
Oh yeah, go ahead and throw it up.
All right, let's see here. Let me hit share screen. All right, so a couple of them. So check this out. So this was the one I was talking about. I assume you can see it. The 10 biggest companies are pulling away from the rest of the pack. And so the blue line is if you exclude the top 10, so they zeroed it in the year 2019, right? So in 2019, if you had $100, in 2025, you have, I don't know, just shy of you probably got like 140. Whereas if you just bought the top 10 stocks, or $100 is significantly north of 250.
Yeah.
Which is pretty significant because that's 2% of the companies. But then you look at this is since 1990. The red is the top 5 stocks. The blue is the top 10 stocks. You can see how highly correlated they are. Mm-hmm. And then if you look at this is the concentration since 1990. You'll note how extreme it is in the top 10 companies, right? So before 2000, it was, whatever that is, 25%. Before 08, it was down to like 20%. And here we are at like 38%. That's crazy town. So it is something that I am concerned about. These are the top 10 stocks by category, right? So the only 2 things that are not tech, and I would argue Tesla's tech. So really the only thing that's not tech is Amazon, which quite frankly is the most techie consumer's good company. And it's tech when you consider that they have Amazon Web Services. So that's actually not correct. So really the only one on this list that's not tech is Berkshire Hathaway. And I think I don't know, man. I think that's something that people need to really be aware of, that you're not getting the diversification right now that you think you're getting. Mm-hmm. And if you had bought an equal weighted index, you would be much more. Let's see if I can find that. If you bought an equal weighted, this is great, by the way. Do not be a UN representative from Papua New Guinea. That's what you have to wear. He is there for a UN meeting, y'all, with a horn. I don't know, boys. I don't know what's going on. So hold on a second. Let's see if I can find this real quick. Now, this is, to be fair, this is your counter argument. The counter argument is, yes, these top 7 companies, for example, of the Magnificent are massive, but they own 850 different companies. And like, if you were to spin out YouTube alone, it would be the 19th biggest stock in America. Yeah. So the counter argument is, yes, you have this massive concentration, but these companies are so core to the fundamentals of our modern life, and they own so much stuff that you're really not making the same bet as you would be making if it was, let's say, Kinko's was in the top 10. Right? Well, if copying goes down, then this is, you know what I mean? So I do think that's interesting. I am trying to counterbalance my thought process with stats like this. But still, I don't know, man. History's been a pretty good guide so far over the last 100 years. And history says this right now. We're really, really, really overvalued.
Yeah, but the problem is like when you look at any of those times, we're also in a very different world right now in the sense of where it's like a lot of the gains that we're talking about that are happening are because of inflation. It's not actual.
Let me share it again. I'm so glad you brought that. This is the most depressing thing I've seen today. Check this out. It was in, let's see, Spencer. I think his name is Spencer. Where's this guy? There we go. This guy. I like following this guy. He's a money manager. But he put this chart up. Here, look at this. Your stocks didn't get better. Your money just got worse. So this is the NASDAQ since January. The red is if you kept the US dollars at the same value they were at January 1. It's like 1.3% growth. But the blue is priced in moment to moment current dollars because we've had 11% currency depreciation. So really, yes, the Nasdaq's up 11.6%, or I guess 12%, or your money's down 11%. It depends on how you want to view it.
And the worst part about that is when you think about it, when you sell your stock, you got to pay taxes on the gain. Mm-hmm. So you're actually down because once you pull it out, then you got to pay 20, or if you hold it long term, you got to pay 20% tax on, or 15, sorry.
Well, they say pulling out's dangerous, Taylor.
No, it can be. They say the opposite, Jeff.
Yeah, it's actually, it probably is a lot lot more dangerous to not pull out.
If you don't pull out, you end up like me with 5 kids.
So I mean that's the huge narrative in crypto, and why a lot of people, and and this includes institutions now, why they talk about Bitcoin being a flight to safety, because it is a hedge. It's looking to be a hedge against inflation. Historically, people use gold and things like that. And now they're starting to use Bitcoin because they see that Bitcoin has pullbacks, but over time you see that it consistently gets higher highs and higher lows, whereas the U.S. dollar over time just has less and less buying power, and it's not necessarily that the price of houses is going up. It's just the buying power of the dollar is going down. Things aren't getting more expensive because they're getting more expensive. They're getting more expensive because the dollar doesn't buy as much. So, I mean, that's kind of why a lot of us in crypto are so are so bullish on getting out of fiat as much as possible and into crypto, because we see what's happening with the overprinting of fiat.
Mm-hmm. And so I'm actually looking something up real quick about that.
Well, and you can see on the screen right now while Jeff's looking that up, I pulled up Bitcoin dominance. And I'm not a chart guy, so forgive the lines, but basically just you can see that they're kind of basically trend lines, where you can see that the kind of the market dominance is riding that line up. It breaks down and breaks that trend line. It bounces on that one for a while, breaks down again, bounces on that one for a while, breaks down again. And so what we're seeing is, this is on the daily. So over the past couple of months, you can see that it's starting to trend down. This is what we talk about when we're waiting for alt season, and the kind of traditional cycle of crypto is Bitcoin pumps first. People make their profits on that. They move those profits into Ethereum, which is kind of what we're seeing right now. Ethereum broke down end of last year, beginning of this year, down to about $1,600, and it's back up, well into the 4,000 range now. And so you're seeing a lot of those profits flow into Ethereum so that people can continue to make profits. After a while, if we keep to the historical cycle, you're going to see those profits roll into the blue chips, the high market cap coins, like Solana, XRP, things like that. And then, of course, last you'll see the smaller cap alts, pump. And then usually what kind of marks the end of the bull cycle is when you see ridiculous shit. When you're seeing just everything pumping, meme coins, people buying cartoon monkey NFTs, buying property in the metaverse. It's all the stuff that we saw at the end of the last cycle.
But what I was doing last cycle, yes, exactly.
Yeah. I was buying SHIB. I had just found crypto and I was buying SHIB.
Well,
what about pictures of rocks that are digital? Anybody can click.
Yeah. No, right? That's what people were buying, and they were paying hundreds of thousands of dollars, sometimes millions of dollars for them.
Let me make all your Bitcoin maxi / crypto people happy.
All right, what's up?
All right, check this out. This is a DXY chart, right? So right here, you can look down here. DXY. See this? So the DXY is the dollar index. So when you hear the dollar's falling or the dollar's gaining, it was created by the Federal Reserve in 1973 to provide an external bilateral trade weighted average value of the US dollars against global currencies. So basically, it's against this basket, right? You got the euro, the yen, the pound sterling, the Canadian dollar, the krona, and the Swiss franc. Okay. So the biggest one is the euro. So here's what this means. Let's use the last I don't know, the last year. So compared to if you traded, your dollar, you would get on a prorated basis 9.45% less of these currencies in return. Mm-hmm. So relative to the rest of the world, as measured by these currencies and this weighted system, we have lost 9.45% in purchasing power. However, something that's interesting is when you look at this over 5 years, we've gained 5%. Since it was created, basically, well, you're at, it wasn't that big a deal in 73, but if you go back to where they back tested it to.
Well, so basically, back to when we came off the gold standard.
Right. So we're about down 18, but here's what I'm trying to get at. We're down 18% against the other currency as a basket, right?
Yeah.
That is different than inflation, because inflation, it hits all fiats at some level, right? So in other words, relative to the euro, let's just say it was the euro. Relative to the euro, we've lost like 18% since 1973. Now, granted, the euro hasn't been around since 1973, but just go in here.
Yeah.
Separately, a dollar, an American dollar, you probably could take in 1973 and go buy an entire McDonald's meal, right?
Yeah.
Now you need like $9 or whatever it is. You can take a dollar from the euro and go buy a McDonald's meal. Now you need like €6. So inflation is happening everywhere. And then currently, because of our trade policies and other things, right, wrong, or indifferent, we are losing extra value just against the other companies. I mean, other currencies. So other currencies are holding up better against us than we are against them. And all currencies are getting affected by the ravages of inflation. So if you wanted, a chart to help you justify getting away from fiat, there it is.
Yeah. No, it's, and then, of course you have DeFi, where, if your fiat is, sitting in a bank, you're losing money due to inflation, and you're losing money, due to devaluation. And then you're also getting paid nothing and allowing the banks to lend your money out. Whereas, you can put it in crypto and, hedge all of that, and also get into DeFi, that we teach on our channel, to where you can earn, very easily 10, 20% with very little work or knowledge. And if you really get into it, you can make.
That doesn't sound like a scam at all. You don't have to know what the hell you're doing or put any effort in.
No, but the reason is because you earn what the banks have been earning on your money historically. They're lending out your money for 7-8%. Then, and that's what they're making, and giving you like 0.01%. So in DeFi, you're basically the bank. You're providing your liquidity so that people can, take out loans, like low interest loans. People swap between different currencies or different cryptos. You earn a very small fee for that, and it's just 24/7, 365 trickling into your DeFi account. And so basically, those of us that are learning this now, we're profiting massively because we're getting in early. Yeah, Mamo, Ricky Romero in the chat. Mamo is a AI. Actually, I'll bring it up real quick.
A good buy. I've done well on it. Thank you, Michael.
Mamo right now on USDC, which is a stable coin that's backed by the US dollar or pegged to the US dollar. You can make almost 10%, and you can make 32, almost 33% on Mamo, just sticking it on here. And all this is an AI that takes your deposit and it over to Moonwell and other projects on Base and invests it and moves it around for you to optimize the yield that you're earning. And that's all you have to do is just deposit it here. And
I know nobody cares about the boomers, right? in this industry right now, but can I just say, you literally said a sentence, which is you put it on Mammo, you move it over to Moonwell,
Nope.
that goes to
I
different bases.
I don't move it anywhere. All I did is I deposited it on Mammo and
No,
the
but that's
eight.
what but that's what it does, though, is what I'm
Yeah.
saying. And
Oh yeah,
that's,
yeah, yeah.
that's just like, I mean, as far as I'm concerned, that's like the financial version of like, man, we need to replace your Fliggenflocker because your second engine and your your gear. You're
Well,
like,
dude,
oh, I guess I should
if,
get my
if
new
if
Fliggenflocker.
you go if you go deposit fiat into your bank, they're taking your money and they're giving it to Joe Smith to go and buy a house or go buy a car or start a business. It's the same damn thing. It's just
I get it. I get it. But
It's
that
the
happens
names.
without any talking about it, right? And this, I
yeah.
understand memos automatic. What I'm getting at is, though, we as a community are saying all this jargon and talking about stuff, and like the regular people that eventually need adoption from to get Bitcoin to 1 million, this just makes them go. They think it's a cult. They're like, what? They don't get it at all.
No, but that's the thing is, we're early adopters, and early adopters, just like buying a stock like Amazon or something like that. In the very beginning, if you're investing in, fundamentals, if you're not investing off social media posts and hype, you potentially, not guaranteed, obviously there's risk when you're early, but potentially, you can make a lot of money. Mammo is, slated to be added to Coinbase's new app, which, like you were talking about with the boomers, they don't understand how to move fiat onto Coinbase and then take that crypto, move it to a wallet, a digital wallet, and then connect that wallet to Mammo to deposit their money and and things like that. But with the new Base app and what Coinbase is doing, basically they can direct deposit their paycheck onto Coinbase and directly on Coinbase take part in DeFi to where they can do what you can do on Mammo directly from their account on Coinbase. This is all about to launch. It's all been announced. So Mammo, Moonwell, Morpho, Aerodrome, a lot of base plays are going to be available to Coinbase users. That's going to remove a massive amount of barriers to entry for boomers and people that aren't tech savvy. But those of us that have gotten in early and bought things like Mammo and Aerodrome and things like that,
Yeah,
we
like
oh, go ahead. Sorry, Taylor.
yeah, Ricky in the comments because like Mammo will give you 10% on USDC, the dollar.
Yeah,
Like you just want to put your dollars there, they'll give you 10%. And he's pointing out like your checking account gives you 0.01%.
yeah.
Okay, so economics says I got to be compensated for risk. So where's the risk on the USD? I'm doing exactly what he said. Why shouldn't I tell my clients, put your cash in Mammo and get your 10% on USDC? Where's the risk?
No. You so USDC is pegged to the dollar. So it's that's not a crypto like a volatile asset. It's just pegged to the dollar. So it's the same as holding a dollar.
So, but
Mammo,
where's the yield coming from then?
the yield is coming from like banks. They that USDC they go over to Moonwell, Morpho, places like that where people go to borrow money and they pay an APY. They pay interest for borrowing that money, and and also it invests in different DeFi aspects of DeFi where people are swapping, they're borrowing things like that, just like a traditional bank.
So
Um,
Jay says that Mammo is integrated on Base app right now.
yeah. It's just the base app hasn't fully launched. It's in beta. They're testing it out now with early kind of early adopters,
Yeah.
people that submitted for early access. So they're trying it out right now, but it hasn't fully launched yet.
Makes sense.
So, but yeah, I mean that's basically all DeFi is. They didn't reinvent the wheel. It just makes people like you and me able to profit like the banks traditionally have. And
Right,
that's
but
why they're so freaked out by it. That's why they have Elizabeth Warren and Gary Gensler, for the past years attacking the shit out of the crypto industry, is because JP Morgan Chase and Wells Fargo and all these people that have massive amounts of money and own politicians, they're the ones that are behind it.
So eventually, though, I mean, I'm correct though, right? That in 10 years, if DeFi is, let's say, 10x the size, then the yield should come down massively,
Potentially, yeah.
right? Because it should be more and more efficient for people to use, which means you pay less and less money to use it.
Potentially, yes. I mean, it's
Which is
all
great
about.
for us if you're in that process. I'm just wondering, you know what I mean? Like, I guess how about this? The reason Chase can pay 0.01% is because the whole world deposits their checking account with them and they don't have to give any more for that.
Well, and
BMO is not going to pay
they're
10%.
doing fractionalized banking,
They're
and
paying 8.
they're lending out your money for 7-8%, and so they can afford to give you 0.01%.
So that's my point is that that's what the market will bear, right? If everybody said, I'm not giving you Chase, if Chase, you have to give me more money or you don't get my money, they would have to raise their rates. So the more money that goes into these ecosystems, by default, the lower and lower and lower the yields are going to go down the road.
Because less people are going to be borrowing USDC. Like the more money you have in there, you can't borrow. Like the reason it's at 10% right now is so many people are borrowing because they think it's alt season.
Yeah.
But just like 3 weeks ago, what was the percent? It wasn't 10%. It was like
I think it got down to like 7 or 8 or something like that.
Yeah. And so it fluctuates with the market with
demand.
Yeah.
Supply and demand. If there's $10 million, say, in one of these accounts, and 9 million is being borrowed, then they're desperate for more supply. They're going to charge, or they're going to give a better APY to draw that liquidity. If there's 20% of the supply being borrowed as opposed to 90%, it's going to be a much lower APY or APR. So that's just kind of the basics of it, but
right,
it's the same.
And I agree with Jay. I obviously rather play with your money than have the banks give you a penny on their profits. I'm not saying that Chase is the better solution. This is obviously the better solution. I'm just saying that you can't. I would be blown away if USDC yields in 10 or 15 years or anywhere are much higher than they are for a money market right now or a CD. Whatever those rates are in the traditional FI world, I think is what we're going to eventually see. You're going to see a convergence is what I'm getting to, because the more things are adopted, the less you have to, the more people giving you dollars, the less you have to pay, because you've got so many people that want to give you money.
Well, Ty actually brings up a really good point, and I kind of want to get each of your take on this. So there's more velocity to that capital or that liquidity on chain. So what he's saying is traditionally, like in banks, money wasn't as liquid, and it really only moved where institutions allowed it to move. Yeah. Now with DeFi, with the liquidity being on chain, it is much more available in a million different directions, because anybody can go on these, and if you have collateral, you can pretty much do whatever you want. As far as borrowing and different DeFi, different aspects of DeFi. So I mean, what are your both of your thoughts, Taylor? What's your thought on what Ty's saying with how kind of how this changes the velocity of the liquidity moving on chain?
Yeah, because if you go back throughout history, one of the biggest problems was, when we didn't have computers. In order to get anything done, like if you were to go borrow money from a bank, the process you had to go through to get money, to borrow it, the bank has to do its research on you and figure out who you are and everything. It took months to get something done. Now we're at the point where you can take your paycheck, put it into Mamo and get 10% because you can lend it out, and somebody on the other side of the world who wants to take a little bit of risk borrows your money and is willing to pay you 10% or whatever they're willing to pay. And all that can move around so quickly now. And, and now the computer can go, well, how are we going to guarantee that you get paid back? Well, we we can see their account. We can use smart contracts.
Yeah.
And so if they drop below the threshold, we'll immediately get your money back. Well, back in the day, a bank, they had to send out the Jewish mob to get you and get their money.
The Jewish mob. So
Jeff didn't get my joke.
No, I went down the
rabbit hole.
I'm going down the rabbit hole velocity on chat right now.
Oh, really? Velocity of money?
So and something to understand about Mammo and why they can pay the 33% is that the Mammo is a accumulation of fees that it is earning off of the assets that are deposited. So Bitcoin, USDC, Mammo, they use the pools on these different protocols that I've talked about, and it is compounding. Like multiple times, I get a text message from Mammo, the AI, once a day, and it gives me a breakdown of, hey, this is how much you earned today. This is how many times it was compounded. This is where you earned it from, and it's it's basically just again, it's an automated, like Taylor was talking about, through smart contracts, through AI. It's just basically automates the whole process. And if you want to take out a loan, say on Aave, I can go deposit $10,000. They're not going to let me take out a loan against that for $10,000. The loan to value might be 70 or 80%. But if I take out the max 80%, if whatever the collateralized asset that I put in there, say it's not a stable coin, say it's Bitcoin, say Bitcoin pulls back more than 20%, I'm getting liquidated. I still have that, 80% of that 10,000. I still have $8,000 that I took and did whatever with, but my $10,000 of Bitcoin is now liquidated, and I lose that because I over collateralized the loan. So, it's important to understand how these protocols work and how these loans work before you get into them. And again, that's why we teach, DeFi, is because honestly, this is going to be a part of the future financial system. And it's important that you understand and learn how it works, because if you don't, you're going to get left behind and miss out on a huge opportunity.
I'll be back.
All right.
Well, actually, I need to get going because I got a meeting to prepare for.
All right, cool.
But,
all right. Well,
and by that, I mean I need to eat.
Well, yeah. So Jeff, before you go, closing thoughts.
Oh, I don't know. It was a great conversation as usual. My closing thought is I need to probably have somebody open an account on Mammo for me.
I'll show Jeff. Just come out. I'll show you how to do it.
Yeah, walk down the hall to Taylor's office.
And of course, immediately when you're talking about, I'm like, okay, sweet. You're telling me I could deposit 10 grand, I could borrow 8, and I could probably find some other place to deposit that 8 and then borrow 6. Somebody borrow that 6 and get all the way down to like $1,000, then just hope you have one like really good day.
Jeff, you just discovered looping. It's an advanced strategy that I can teach you.
It sounds dangerous as hell.
If done right, you can mitigate quite a bit of risk on it. But it is a technique that you can do to lever up your basically your liquidity. But Taylor, before you go, what's your final thought?
My final thoughts are: I know the Jews have caused a lot of problems.
We're going to end with anti-Semitism. All right,
no, they're all in the media right now. Okay. But I'm just kidding. I'm not going to talk about any of those issues and the slave trade and the opium trade that they did. But, beside all that, you really can you can get 10% on Mammo right now. It's not always going to be like that. When alt season kind of goes down, people are going to be borrowing less. It won't be paying out as much. But if I just really cannot wait to the day that a really good system that is insured is set up where my employees, I can deposit it into an account like Mammo for them. They can use it. They're getting 10% off of, or, whatever percentage that they're going to get off, but it's in USDC and they can transact and do everything. We don't need to be dealing with all the banking industry.
No, absolutely. And so, yeah, I mean, my closing thoughts are this: Moonwell is basically setting itself up to be a bank. They have a card that that they're introducing, a Visa card that you'll be able to use to spend your crypto. But it is going to be basically a bank account, and it's what Mamo is using. But these are the pools that are on Moonwell and the APRs that you can earn on each of these assets. So yeah, like a Tether, you can actually earn 14.4%, another stable coin.
Wow.
So yeah, there's a lot of advanced strategies, but if you want to learn about how to do this stuff, and what Jeff was talking about is referred to as looping. If you want to learn these advanced strategies, definitely find us on YouTube and DeFi crypto and airdrops, and join us on Wednesdays where we'll be talking about these advanced strategies and how you can lever up and hopefully change your family's financial future. So till next time, appreciate everybody in the chat, everybody out there watching. Veteran Crypto out.